right, hello everyone. It's 3 p.m. and it's time to start. I'm sure that we have more people joining, but in view of the time, I guess we should start. Let me do a quick intro about what's happening today, and I'll then give the word to our host, who is going to be Darren. So again, hello everyone, and thank you for joining the 73rd weekly IPOR Hangout. I hope the state of everyone's bags is neutralizing the strong FOMO that crypto is going through currently, and you are all enjoying the bull market vibes. Today we have two guests, very special guests from companies that look at DeFi and staking rates and rewards in particular from the vantage point of traditional finance. I welcome Martin Leinweber, digital asset strategist at MarketVector, and that's a company specializing in investable index solutions, and Josh Deems, who is business development manager with a focus on staking in Figment, who are building digital asset staking solutions for institutions. Today's discussion will be led by, as I mentioned, Darren Camus, who is the co-founder and CEO of IPOR Labs, and I'm sure that Konstantinos Toulos, IPOR Labs BizDev, will be jumping from time to time. We have also other team members, and I'm pretty sure that we have a number of community members who will be joining us. The topics, as I'm sure you're well aware, will revolve around ETH staking rates, staking rewards, institutional products, and the effects of the ETH ETFs. So if anyone has any questions or comments, please share them as a reply to this Twitter Space link, and I'll make sure they receive proper attention. And with that, I surrender you all in the capable hands of Darren. The floor is yours, sir.
All right, thank you for the introduction. Thanks, Josh. Thanks, Martin, for joining today. So, to kick things off, we'll just jump right into the meat. When ETH ETF, if you guys could just put a date, a time, and a price estimate, and then everyone's happy and can go away, smiling.
Darren, I'll give you ETH, I'll give you Bitcoin, I'll give you
Okay.
Solana. I think it's all going to happen tonight. I'm just kidding.
But whose night? Whose night? Because we're all around the globe, some people's night is some people's
That's
morning.
true.
So. All right, cool. So I guess, Justin, since you started, can you guys maybe give a brief background of yourselves, and what your organization does, and why is institutional finance or traditional finance looking at this kind of crazy, the dark woods of Ethereum and looking at this ETF, and what does staking have to do with it?
Sure, I can get started. So, nice to meet everyone. My name is Josh. I cover institutional business development at Figment. Um, I've been in the crypto space for a long time, but I've been with Figment for almost 2 years. But previously was at both State Street and Fidelity, working on some kind of early iterations of some crypto projects and help build a custody platform at Fidelity that's now being fairly widely used. But I think what really attracted me to Figment and what I think the opportunity that we have right now is it was around the time when Ethereum was planning on moving from proof of work to proof of stake, being kind of the second largest cryptocurrency by market cap and definitely second largest or largest by some metrics on developer activity. I saw there was a huge opportunity to help institutions get exposure, and I saw that exposure wasn't just going to come from holding the asset in deep cold storage like we would do if you were to purchase Bitcoin, but there's ways to make it available on familiar rails and unfamiliar rails. And so for TradFi, unfamiliar rails are probably a little bit more down the DeFi curve, but familiar rails are things like ETP and ETF wrappers, where you can take a strategy, you can put Ethereum within it, you can do staking, etc., so long as it's approved by the regulator. And then you can bring a product to market that's available in people's brokerage accounts, and you can go purchase it on Robinhood. You can purchase it on Schwab. Much to Jamie Dimon's chagrin, you could probably go purchase it on your Chase brokerage account. So it kind of puts crypto in a familiar wrapper. It's not kind of the end all vision of decentralizing finance completely, but I think it's kind of a step in the right direction, using familiar structures and under the familiar regulations that larger institutions have to comply with.
So what exactly is Figment's role in all of this?
Yep. So we power the staking of the underlying Ethereum or 35 plus other blockchains. So our primary role is to help these institutions who want to get exposure to a rewards rate on top of a layer one proof of stake blockchain, or even a layer two proof of stake blockchain, exposure to do so. So we can, we have an API and a platform driven solution that allows you to stake, all held in your own custody, whether it's third party custody or your own self custody, and earn rewards directly by participating in network consensus. And by doing that, we also allow you to see rewards reporting, etc. So we kind of serve multiple layers of institutions, kind of larger institutions through direct relationship, direct partnership, usually with their custodian, but also we help service, kind of on the high net worth side. We do have a self-service app called the Fig app that allows holders of Ethereum to stake their Ethereum directly through Figment validators.
Okay, very cool. Thanks for the overview. And over to Martin, can you tell us a little bit about yourself and also what your company does?
Sure, yeah. Hello, everybody. My name is Martin Leinweber. I'm working as a digital asset product strategist at MarketVector Indexes. So we are an EU benchmark regulated index company, and we started digital asset indexing in 2017. So maybe not everybody is familiar with indexing, and I'm glad, Darren, that you brought up this ETP, ETF debate. So our clients are mainly ETF, ETN issuers, and they need an index they can replicate. And I think I'm pretty excited about what is happening next year with the spot Bitcoin ETF, because I really do think that we get an avalanche of new money, and very rapidly also I think in ETH ETF will the market cap of the whole crypto market. We are around $1.5 trillion dollars, and if you look at the ETP market, it's around $45 billion. So pretty small, and that's including Grayscale with around 30 billion. So I think when the spot Bitcoin ETFs are opening up in the US, that will also have an effect for all other ETP issuers around the world, because the perceived carrier risk is suddenly lower. And with, for example, MiCA in place, the market and crypto asset regulation in Europe, I can imagine that more issuers will follow through, and also more investors are willing to invest in those vehicles. And so that is in general bullish for crypto, but especially for the large cap tokens such as Bitcoin and Ethereum. Yeah.
Okay, great. And thanks. Maybe just to round it out, I'll give a really quick introduction to IPOR for those who aren't familiar with it. IPOR, it's actually the DeFi component. So very interesting. We have two institutional players and a very DeFi native protocol, and it's sitting on both sides, both the index side. So the core of the IPOR protocol is the IPOR index, which we call the heartbeat of DeFi, or the risk-free rate on-chain. It derives its index from the on-chain money market activity in money markets such as Aave and Compound. And then a product that will be coming out very shortly is the ETH stake rate swap. which is trading the Ethereum staking rate. So essentially a derivative on this kind of staking index that we're going to talk about today. So we have a very interesting kind of mix of DeFi and institutional service providers and institutional products. So maybe we can take a kind of a step back for those who aren't familiar with, let's say, the traditional product wrappers for Ethereum and go over the landscape. What's an ETF? What's an ETP? What's an AMC? We can bring in all kinds of acronyms, but what are they? What's the difference? So what are some of the major differences? And then maybe in the case of ETH staking yield, what is possible in each of these instruments?
Definitely, I can get started, and I think maybe might be helpful for me to give a North American perspective and sort of kind of pass it off to Martin to talk about the European perspective because they're very different in terms of what's allowed in a product. So an ETF is an exchange traded fund, and it's basically a fund that follows a strategy, but it's traded through a traditional exchange. And so obviously we have this process in the United States where new ETFs are proposed actually by the exchange that they're going to be listed to be traded on. So you hear about BlackRock and Fidelity and Wisdom Tree and others applying for an ETF. And that's actually not entirely true. It's the exchange that they're going to be listed on that's applying for a rule change that will allow that exchange to list an ETF that's issued by that particular fund manager. So an ETF in the U.S. Is generally fully collateralized by the underlying, and it works in the same way as an equity works. So it can be listed on NASDAQ or NYSE or any of the other large U.S. exchanges, and it can be traded, freely between folks on the primary market, and then new shares are issued to subscribers via a fairly complex subscription process. So we don't need to get into like the nuts and bolts of how subscriptions work. But at the end of the day, the real benefit of an ETF is it allows you to take either a passive or actively managed strategy. Passive being, I want an ETF that simply tracks the price of Ethereum, or even I want to track the price of gold, or even the S&P 500 to something that's a bit more actively managed, which would be, either a factor-based ETF or an ETF that has a rules methodology that's more complex than simply tracking in the exposure of an underlying index. In the U.S.,
So how would this differ for something like the CME Bitcoin futures?
Yep. So CME Bitcoin futures are cash settled. So there's no Ethereum or Bitcoin underlying those products. They're simply a tool for price discovery, and they're a tool for setting rates. But if you were to own a Bitcoin futures, either ETF or even just the underlying future, the future itself, you don't actually have exposure to the asset. There's no Ethereum sitting in a vault somewhere, or Bitcoin sitting in a vault somewhere that's backing up that contract, or that product. It's effectively just paper. And so with an ETF, the ETFs that are being proposed in the US, they're spot ETFs, which means they're going to be holding physical Ethereum or physical Bitcoin in a vault somewhere, or in a custodial wallet somewhere, on behalf of the shareholders who then go out and purchase shares of the product. So it's basically a way to take something like Ethereum and bring it to people who maybe are going to be less crypto native, or they want to hold it in an account type that doesn't allow for crypto. It's like a retirement account or something like that. But you don't need a wallet, you don't need an exchange, you don't need a staking agent, etc., to go out and buy shares of a Bitcoin product or an Ethereum product. You can just simply log into your brokerage account and have access to it there.
Yeah, I mean, it makes sense. Like my mom can't keep her email password up to date, so trusting someone with money is a very different thing. It's a bit different, and anti-ethos to crypto, which is not your keys, not your coins. But I guess in the regulated sense, in a lot of these fund structures, a custodian is a requirement by a law. Is that right?
Yeah, yeah, I agree.
And then what are some of the restrictions that the custodian has, for example, that might be present in an Ethereum ETF?
Yeah, so custodians or investment advisors are generally required by law to have what's called a qualified custodian um, holding assets or securities or cash on behalf of their end customer. I mean, it prevents a major conflict of interest where the advisor could basically run away with the customer's money. It's basically separating duties, and that rule goes back all the way to kind of the end of the Great Depression of the 1940s in the U.S. When it came to life. But in terms of an Ethereum ETF, you're 100% right, Darren. I mean, it's not something that people are going to be able to quote unquote self custody. It's a bit of I think it's a step towards the ultimate vision of decentralized finance, but I don't think we go from the existing securities and capital markets ecosystem to something that's fully decentralized overnight. And I think this is kind of a stopgap where folks who are maybe a little bit less crypto native, like I was saying earlier, or even crypto native folks like I would consider myself, I would actually go out and buy this product and put it in my retirement account. It's not financial advice, but I can't go out and buy Ethereum in a wrapper today in the US and have it in a tax advantaged account. So you do need a custodian in order to do that. The custodians, in some cases, they do provide staking services. In other cases, they would either white label their staking services to someone like a Figment, or they would just have an open partnership with someone like a Figment to achieve those staking services. So the names that do operate their own staking services would be someone like a Coinbase, and then kind of most of the other ones would outsource to a third party like us to help achieve or help generate rewards on top of the Ethereum that would be sitting underneath the product. Now, I think it's also important to note that I don't believe that most of the products, when they come to market in the US, the Ethereum products I'm talking about, will have staking as a feature on day one. I think the Ethereum ETFs that come to market will, we're dealing with an SEC that has been fairly hostile to the notion of even a Bitcoin ETF. And so taking Ethereum product and coming to the SEC and saying, well, we're going to provide, or we're going to stake, 25, 30% of the underlying Ethereum in this product. I don't see that happening on launch date, but there is a process for amending the strategy of an ETF once it's launched. And I think, I would hope that at least, within 12 months after the Ethereum products get launched, at least one or two of them are providing at least some sort of staking return or staking rewards on top of the Ethereum that's backing the product.
Yeah, there may be also maybe a more cynical view where the actual custodian's model is to actually keep that staking yield for themselves while the end user doesn't get exposed to this, right? So this is also a possibility.
100%.
So let's roll across the pond and see what's happening in Europe. Martin, you mentioned Mika. There's a lot of different fund structures possible. So what are you seeing from the European landscape?
Yeah, so I mean, while the US guys are all waiting for the ETF, I mean, we already have that in Europe. It's called ETN. It works quite similar with the difference that you don't own the assets in an ETN because it's like a promissory note from the issuer. Yeah, you're buying a bond from a bank, so to say. They collateralize this note with the underlyings they invest in, but they don't necessarily have to. It could also be a different collateral set. So you have to look at the structure. Generally speaking, in Europe, you are fine with the ETNs. They work quite similar to the ETFs. So you have the collateralization. It's trading close to NAV. We just have the ETNs there because according to the European usage rule, you're not allowed to invest in a single token. Yeah, you always have to have a diversified basket. And so the ETNs are a way of avoiding this and making an investment in Bitcoin or Ethereum, for example, possible. And I agree with Josh that we won't see an ETF soon with staking included, but my hope is that when we see the momentum from the US next year, and we are already talking to clients that they will incorporate staking in their products. And I mean, honestly, why shouldn't you? Everybody in every asset class, we have a total return view, meaning that if you invest in equities, you want the dividend, right? And if you don't do staking, for example, in Ethereum, you leave some of the cash flow on the table. And I think it's also a question of transparency, and that's the reason why, together with Figment, we built this benchmark in order to bring more transparency into the space, so that an ETN issuer, on the one hand, is able to identify which staking provider delivers a superior return or is maybe below average. And also it's good for the end clients because they can see, okay, do I get my fair share from the ETN issuer? Or as you mentioned, Darren, do they keep all the money for themselves? And I think we are not far from that. And so I think next year we will see the first products, including the staking yields.
Okay, cool. I really want to touch on the index a little later on, but I had a quick question. Like in the landscape, you also have you know, LSDs or LSTs, liquid staking tokens or liquid staking derivatives. Have you seen or will we see wrapped versions of this?
I can imagine, yes. So I know that some issuers are also thinking about investing in a diversified basket of liquid staking derivatives. Why not? I think I can also imagine a mix of non-custodial staking. You are at a staking as a service provider, but you are also buying liquid staking derivatives because liquidity is a big thing. Yeah, so with staking, you are locking your ETH. You're bonding it for a specific time. Yeah, in ETH, you have the entry and exit queue. And so if you have a product which offers T+1 liquidity, of course, that's an issue. And so you definitely can't stake 100% of your fund. So doing that via the staking derivatives or adding that in addition to your normal validator set is definitely a thing which we will see.
Yeah, that's interesting. If we take you know, one of the examples of what happened in the last market cycle, you had the you know, you had the queue, which didn't have the merge yet. We had this you know, ETH staked ETH arbitrage possibility, and this was one of the things that really you know, hurt Three Arrows when it was trying to exit its position, right? You had this nice kind of staked ETH discount because you had this illiquidity risk. But you know, now that we're on now that we have the Chapella merge, then we haven't seen this kind of big backlog. But what might the exit queue look like, and what are the liquidity risks? You know, actually maybe post ETF. If you get a lot of these you know, Ethereum that gets staked, you know, what happens to the rates? What happens to the entry and exit queue?
I mean, that's a good question. Maybe Josh, you can elaborate on how the execute changed, right? I think we are at the higher end.
We
Is that
are.
correct?
We are, yeah. So what we saw was there was pent up demand, Darren, to your point, Chappello, which took place in April of this year, finally allowed for folks to be able to withdraw their Ethereum from validators. So it was Ethereum plus Ethereum rewards that have been generated, which obviously is paid out in ETH. And a lot of people unstaked unwound transactions and then decided to restake, or folks who had not staked in the first place decided to stake in order to, you know, take advantage without having the lockup, where the lockup risk was actually on like the developer's ability to bring Chapella functionally to the protocol. So your risk is actually with the developers. In the timeline of that. So I think a lot of the larger institutions and even individuals were unwilling to underwrite that risk. What we're seeing now is on the other side, there is a queue, and sorry, to finish that thought, we had a queue of about 40 to 45 days, where if you wanted to stake or stake to an Ethereum validator, which requires 32 ETH to do so, it would take about 40 to 45 days before that validator becomes in the active set of validators, and there's sort of this like interim purgatory period where you can't once you initiate staking to a validator, you can't withdraw that ETH. So you kind of have this 45-day period where you have risk on the protocol. You don't have access to your ETH in order to trade it. It's really just sitting there until the ETH becomes part of the active set of validators. And then on the outbound side, when Shapella was first introduced, it was maybe 5 to 6 days max to withdraw a validator, and because there was limited demand in order to do so, there's only a certain number of validators that can be included on the entry and exit queue in every epoch. And so what we're seeing now is the entry queue has effectively been cleaned up, and there's no wait to enter the active validator set. The wait would be a couple of 12 hours to a day at max, and on the outbound side, it's about a little bit longer than a week. And we expect Ethereum's reward supply dynamics to change over time. Rewards are really a component of the two layers of Ethereum. There is the consensus layer, which is the standard network inflationary rewards that are paid out to validators. And we expect as more validators come into the Ethereum network, that rate goes up, but not per validator. So per validator, the amount of available rewards would go down, even though the bucket of available rewards would increase. So if you're a validator and you're generating consensus layer rewards today, they're about 2.5%, 3%. Over time, if we see more validators come onto the Ethereum chain, that number would go down per validator, although it would go up. It would increase. Now, where we think validators will see the biggest opportunities over time is what's called execution. It's called generated rewards from the execution layer. So by validating transactions, you're also receiving priority fees, tips, and if your validator uses an MEV compliant relay, you're receiving rewards from MEV as well. And so you can effectively the consensus layer reward generation is fairly predictable. The execution layer reward generation is less so, and it depends on how much the users demand block space, how much congestion is happening on Ethereum, because if there's a period of large transaction volume, for instance, people may be paying more in order to have their transactions executed more quickly. There may be more MEV opportunities, and so the execution layer rate fluctuates, whereas the consensus layer rate stays fairly steady. So the consensus layer rate goes down as more validators participate on the Ethereum chain, but the execution layer fluctuates based on block space demand. So that could be up or down over time.
Also, I have to highlight that while everybody's looking at the nominal ETH yield, I also have to say it's a real yield, right? So the real yield is even higher as Ethereum is deflationary at the moment, and we've never seen ETH after the merge over the full cycle of the full bull cycle. So we could even see more deflationary tendencies. And there are not that many proof of stake protocols with a positive real yield. Yeah, for example, Solana, I think if I remember right, they issue 30 million a day for the security budget, but they just make $180,000 per day, and not the 2 billion per day as Ethereum does. And so people should also look at the real yield, and that's very favorable for Ethereum.
This sounds like a very big ultrasound money proponent.
I like scarce assets and deflationary assets. Yes.
I have a one of one NFT just for you, sir. Uh, Josh, I had a question from Figment side. Do you have any restrictions or across the entirety or any of your nodes against MEV?
To generate MEV, Darren?
Yeah.
So actually, we there's a couple ways to think about MEV generation, and we are doing a couple of different both thought and actual experiments here. Today we participate by using Flashbot's relay, and when we have a policy of using MEV that is OFAC compliant and but also going to be what is net positive for Ethereum. We're not going to use, or we're going to, the best of our ability, not use an MEV relay that is prone to network manipulation. And so it's things like performance, things like the ethical components underlying the MEV relay. Like, we don't want to actually select the order of the transactions in a block proposal. We want the MEV relay to effectively do that on our behalf. So those types of things we consider. And today, like the solution that best met our needs was Flashbots, but we do use MEV relays for block proposals, and in the future, we're looking at other solutions as well to be also like there's market manipulation components that we need to consider, especially as Martin mentioned, Mika. A big component of Mika in Europe is being able to prove that you're not participating in market manipulation. And historically, some sources of MEV rewards could effectively be seen as manipulating the order of transactions to the benefit of one party and to the detriment of another party. And so we would consider that, likely not something that we'd want to participate or put our clients have exposure on our clients' behalf to. So we do have a MEV policy, and we are, not only using Flashbots but looking at adding others over time because we think there's some good development going on in the space, especially with more custom MEV solutions that some of the larger institutions are going to want, because institutions aren't just going to want to capture consensus layer rewards. They're going to want to capture the execution layer as well. But in order to do so, they're going to need to prove there's no market manipulation, and there's sanctioned address compliance, whether OFAC here in the U.S. or the European equivalent.
Okay, cool. And I guess you guys can hear the drilling in the background. I'm living in eternal construction, and I have literally drilling on my 4 different walls. So apologies about the background noise. So maybe we can jump in more, like a little bit deeper on the CL and EL rewards. What do you think? How do you see this developing in this next market cycle?
Yeah, I just think what we've seen so far is that, especially the execution layer rewards, they are super volatile, right? And it's basically demand for block space. If you look now at our staking rates, it's pretty low. I think it's around 4.5%. Just to give you a perspective, during the March banking crisis this year, the whole staking rate was 16%, with a majority of the rewards coming from MEV. So for me, it's always also, I like looking at the staking rewards rate to see the status of Ethereum. Is there craziness going on? Is there really high demand for block space? Is there MEV opportunity? And at the moment, we can see, yes, we have rising prices, but there is not the FOMO going on we had in the last bull market cycle. So in addition to the low rate we mentioned a few minutes ago and real rate, people really have also to have an eye on the execution layer rewards and the MEV opportunities to earn extra rewards. And I just can imagine that it will be volatile during the next bull cycle. Yeah, whatever new killer use case we will have, whether it's the NFT craziness again, or it's another app we don't know yet. But I don't expect that we just see decreasing rates and a low volatility during the next cycle. I don't know how you think, Josh.
Yeah, Martin, we actually, and Darren, this is kind of a fun time to bring this up, but if you look at the dynamics in MEV over the course of the last, I mean, Ethereum has only had, the Chapella upgrade was only about 7.5 months ago, or even actually 7 months ago, almost exactly. But there was a period just before there's a date, March 11th, that Martin and I have sort of ingrained in our brains, where the rewards performance on Ethereum MEV opportunities hit an all-time high, and March 11th was the date that Silicon Valley Bank filed for bankruptcy, was declared insolvent. They're one of the largest holders of USDC. They were one of the bankers for Circle, and USDC effectively lost its peg. And when USDC lost its peg, people, arbitragers on Ethereum were trying to net out sort of the delta between where USDC was trading and its peg at $1. And by doing so, they generated a fair bit of MEV opportunity. So I think opportunity is generated by demand for block space, which could be something net positive, like let's say, I don't know, Adidas comes out with a NFT that's traded on Polygon, and by nature of that, there's rewards generation opportunity on top of Ethereum. We're seeing a huge demand, a huge spike in usage on the Ethereum chain, et cetera. And the delta, the backside of that would be if there's another banking crisis, or there's something that is going to impact Ethereum's liquidity, and or crypto's liquidity to that effect, and in that case, you would start to see maybe a depegging of a major stablecoin. Maybe a layer 2 gets shut down for technical reasons. There's a whole host of reasons that we could see a race to get as many transactions through at any given moment. So it really does depend on the market dynamics, on the amount of outstanding liquidity. And if we do have, I think to draw this back to the ETF conversation, if we do have a large number of Ethereum ETF issuers that are staking the underlying, it could either result in a large upswing in rewards generation, and those products maybe get inflows, or it could go to the reversal, especially if those products aren't staking the underlying Ethereum, and that Ethereum is just sitting in cold storage. Let's say there's an insolvency of a stable coin that's traded that's built on top of Ethereum. You could have a situation where people are trying to unwind or redeem their ETF shares, and if that product is staked, the issuer can't meet the redemption period, which is generally T+2. And we talked about before, Ethereum has about a 7 to 9 day unvalidation period or unbonding period. Something like that could really cause a massive negative impact on price, on liquidity. You could see potentially if something like this were to happen, and ETF issuers can't meet their redemptions because tokens are bonded. You could see a real correction in terms of Ethereum price. So I think it goes both ways, and those are sort of adverse or super kind of black swan scenarios, but that's really the downside of what what could happen if Ethereum gets staked in an ETP through a cycle of, kind of high reward generation, even though high reward generation doesn't necessarily mean that if there's positive activity happening on Ethereum chain.
Well, maybe we can reterm this because black swan comes very infrequently. We could reterm them gray swans because again, this is crypto. So you guys mentioned March 11th, and that was actually a very interesting time for the IPOR protocol. You mentioned SVB, USDC, DPEG. You had a lot of people, Chicken Little, the sky is falling, USDC will, DPEG like Terra, and obviously that wasn't the case because it's asset backed, but we had very interesting things happening in the DeFi money market. So on the IPOR rates, the USDT spiked up to, I think, about 45%, and the USDC dropped. So there's some interesting like spread trades that you can put on those two different indices. If you're doing the interest rate swaps. But the other one is the nice arbitrage that could be, so one kind of big-brained strategy that we were following was one of the major LPs. They withdrew all of their assets from IPOR to play the very interesting USDC repeg event. So they marked down the chance that that USDC is going to collapse. They ended up actually maxing out all of their on-chain credit lines, borrowing USDT, running that utilization rate up to 100%, paying around 80% per annum. Actually arbing the 8% premium on the 6% premium on USDT, exchanging it for USDC and playing that potentially 8% repeg. And then the cost for this arb trade was really the interest rate over that time. So that was a really interesting way to potentially use the IPOR protocol, for a nice carry trade. On the other side, you mentioned that the Ethereum staking rate jumped up that time. So this is one of the other cases, right? So the product that will be launched on IPOR is going to be the stake rate swap. Stake rate swap trading the Lido staking rate actually intraday. So you can day trade this activity. So that would have also been an interesting leg to this trade, essentially paying fixed. And as you mentioned, it's not straightforward. Structurally, we'll probably receive fixed, assuming that more validators will come online. That will drive the CL rewards down. But the execution layer, it's typically, I've been sitting at my computer trying to look at DeFi, going from 3 to 6 Gwei, and now looking at 30, and it seems pretty juicy because 30 is not 80. So we're going into different market dynamics. So how do you guys see things like, let's say, derivatives of the Ethereum staking rate playing out in this next cycle?
Yeah, so I think these kind of instruments are completely missing at the moment. And I mean, I'm coming from a TradFi bond background, right? And the interest rate swap market in bonds is massive, right? It's $500 trillion with a T, notional outstanding, and I don't know how large the DeFi swap market is. Darren, you know it better, but it's just the beginning, and I'm very bullish on that because validators need to hedge. You have family offices, hedge funds who maybe want to play a rising Ethereum staking rewards rate because they are expecting more block space demand for whatever reason, whether bullish or bearish. And so I welcome that you guys are working on such products. And I also think that market makers in the TradFi space will work on that. At least that's what I hear at the moment. I mean, we are early. So it's really nice to see that you already have a product in place.
Thank you. And also on the receive fix side, we have like someone like a Figment that might be interested structurally. more as kind of a fixed income player. And there's another way that you can see it kind of as an Ethereum node operator. You can see it as kind of generalized slashing insurance in case your rate drops because of some technical outage. So maybe Josh can speak a little bit on that side.
Yeah, I think we see a couple different use cases for or an interest rate swap. We actually executed one a little over a year and a half ago with the counterparty. We published this publicly, so the counterparty was FalconX, and we did a dot swap, a fixed versus floating rate swap, and Polkadot has a very different staking rewards generation proof of stake model than Ethereum does. It's a delegated proof of stake model, and we needed to get enough DOT to get into an active set on behalf of a customer. And so we were willing to take an interest rate swap with a large counterparty. Now, I don't think any, the real use cases for interest rate swaps wouldn't necessarily be what we were using it for. That's kind of a niche, maybe one-off scenario, and that was just because we had some own balance sheet liquidity rebalancing that we were going through at the time. But I think for someone like us, it's going to matter more for our clients who, we are working with some of these large ETP issuers, ETF issuers, especially in Europe, and they want to hedge against what we were talking about earlier, which is the amount of time, the time delta between receiving staked Ethereum and having to meet redemption obligations. And so you could imagine using a staked Ethereum position as collateral for a short-term loan, and the staking rate is effectively paid to the lender as interest. In order to hedge that, or in order to even build that product, you would need something like an interest rate swap in order to execute it. So I think there's that's kind of the main play that we see. Given the network is paying our customers, we don't really need to hedge our own exposure because we're not taking rewards and depositing them to our customers. They're being deposited by the chain itself. They're interacting directly with the chain. They're just using Figment as the go-between. There's no custodial aspect on what we're doing. But the customers that are custodial on their end, they're definitely going to want to underwrite a loan against their stake position where maybe they're foregoing when you're exiting the Ethereum validator queue, you're still earning rewards. So maybe they're interested in giving up those rewards plus a premium in order to get liquidity to meet a redemption obligation. That's really where I, at least from my seat, see the largest potential use case. And they also may want to, if there's a large enough Ethereum holder, let's say BlackRock has, a multi-billion-dollar stake ETP, and rather than provide subject their customers to a floating rewards rate, where we talked about all the dynamics earlier that impact the rewards rate on Ethereum, they may want to, say, hey, customers, we're going to lock you in at a fixed rate. And it's more like an income generation ETF, and maybe there's some sort of dividend payout on a quarterly basis. And in order to meet that dividend payout, they're willing to forego a floating rate in exchange for a fixed rate. So we see it more on the client side, Darren, and I think it's more from my perspective. It's with the ETP and ETF issuers who have Ethereum supply considerations, liquidity considerations when they're bringing these types of products to market. I think there's potentially some interesting use cases as well on the market maker side, on the authorized participant side, folks who are providing the liquidity for these ETPs and ETFs. But I think the largest use case we'll see is on helping bridge the gap between TradFi security settlement and Ethereum on bonding queues.
Yeah,
Okay.
and also maybe one remark. I think it's also not about just fixed and floating, but also about maybe you can use a currency swap, so that you have suddenly everything in US dollar terms, or you can also construct a basis swap where you are betting on the off-chain and on-chain worlds, for example, a rising Fed funds and a lower ETH rate, for example. So that's also something I'm very excited about. I don't know how you think, Darren, about those products.
You mean if on-chain that you could swap DeFi native rates, what we call RWA rates, or TradFi, the treasury rates, the SOFR rates,
Right.
and the
So
Ethereum
far, yeah.
staking rate? This would be a very interesting marketplace indeed. I hope that someone's building this. So, a couple of things that you mentioned, sorry, Josh, also about your clients, and then Martin about what you want to trade. This is always it's more sophisticated, sophisticated players. The larger you are, the more that you want to hedge, the more that you want to protect, right? And this is pretty much the nature of the game. I think a lot of the reason that people are not so familiar with interest rate derivatives in DeFi is because we have a lot of more of the early speculators now, but a lack of maybe more of the sophisticated players. And even rates, as large as it is it's a subset in traditional finance. So I mean, this is something that we're looking to that we believe will happen in this next run, as you'll have a lot more sophisticated players coming in. You'll have much more, have the kind of the advent of structured products on chain. And another thing was, I think I lost my train of thought. I just ran around and got lost. So I'll let you guys take it.
No problem. I think, Darren, maybe Martin and I can spend a few minutes talking about index construction. I think it's part, like, we're talking about interest rate derivatives on the Ethereum chain, which I think are, everyone's looking at. I think there may be like, maybe 6 months, 3 to 6 months out. Something more immediate is larger institutions are going to need to benchmark their performance, and especially if they're an ETP issuer, an ETF issuer, to a total return index. And Martin was sort of mentioning this before, but if you think about like there are ETP issuers in Europe, for instance, that are and in Canada that are staking components of their underlying ETH index, or of the underlying ETH holdings every day. Some of the limitations we talked about before are on the liquidity side, and some of the limitations on the what we call the utilization rate are imposed either by the securities regulator or by the actual like fund operations and risk management of the product itself. And so Martin and I designed an Ethereum total return index that considers the utilization rate of the product. So let's say you're only comfortable staking 25 to 30%, or you're mandated to only stake up to 30%, or you have kind of a more bullish view on you're not needing to meet redemptions, and you'd stake up to 80% of the product. We developed an index that's custom, and that can be modified based on the preferred utilization rate. I think there's some other really interesting components of the product, but really what we sought out to do was to build something that makes institutions more comfortable staking the Ethereum in an ETP ETF, or being used as sort of more of a TradFi primitive underlying interest rate derivatives. So we have our rewards rate and our total return index, and they're both, by virtue of working with MarketVector, it's fantastic because we actually have what we believe is the first regulated Ethereum rewards rate. It's available on Bloomberg, so anyone who's kind of TradFi by day, crypto by night, can go in and see our rate there. It's the staker rate, STKR, and we hope that this is the benchmark that institutions will use when building Ethereum staking products. Today, people benchmark to the Ethereum price, and you as a shareholder don't really have insight into what the rewards generation is. A lot of the ETP issuers may not be, and they're not required to disclose how much of the fund, the underlying holdings, are being staked. and therefore you don't really know what your pro rata share should be of the staking rewards that are being generated. And Darren, you mentioned earlier, and this is absolutely true, is that there may be some products out there that are taking the underlying Ethereum, staking it, and you're not receiving any of the rewards as a shareholder. So we think that this will usher in more transparent products and products that are benchmarking against the true rewards performance of Ethereum, not just the Ethereum price. And that'll create, the market for total return products in the same way that, if you have a total return S&P 500, dividend producing S&P 500 ETF or whatever, you're going to want to know what the dividend yield is on that product. You're not going to consider it good enough that there's some sort of dividend payout, and you'll take what you can get. If you're a financial professional, you want to know exactly. You can compare the performance of the index to the actual S&P 500 and look at the dividend yield of the S&P 500. And so we see this as the same thing, right? You want your dividend yield on top of Ethereum. You want the rewards generation to accrue to you for investing in the product. So that's a big thing that we set out to do and build, and we're working on potentially other chains in the future, but we think this will at least help with Ethereum and some of the larger ETP, ETF issuers. Martin, I don't know if there's anything more you want to say about the product. There's certainly, we could have spent a whole hour on it.
No, well said, Josh. Yeah, well done. We hire you as a business development manager. Yeah. have to speak with Figment first. No, but I think apart from the index we have out there, everything can be customized, and I think that's pretty important. So if a client just wants to focus on the execution layer rewards, we could also build a rewards index on that. Yeah. Or if you want to include your off-chain costs, we could also deduct that. We think as a benchmark, you should include everything, 100% of the Ethereum chain, a native yield, so to say, before any costs, and a 100% validator set, as I think there are no good or bad rewards, as they are all on chain. So that's the truth. Very excited about our benchmarks, and my hope, again, I'm repeating myself, but I think with the bull market, my hope is that we will see the first staking yield products out there.
Okay, very cool. I remember what I forgot about. So one thing about this, about the index, about the yield products, about people wanting to protect their yield. On chain, you have different products, right? Really, in the yield space, you kind of have two flavors. One is the interest rate derivative, something like IPOR, or you have the yield stripping, right? So the yield stripping is essentially a bond market. You strip out the yield component and you create a secondary market for that. But if you're an institution, can be problematic if you're assessing counterparty risk. So, for example, I think for institutions, it's a hurdle just to get, if you wrap in LSD, for example, that's already smart contract risk. That's counterparty risk on the other side. If you deposit that, LSD or LST into a yield stripping, then you have another set of smart contract risks, and then you have the market risk on the yield itself, right? So from the custodian perspective, from the institutional's perspective, do you think that there can be institutional adoption around this, or would institutions look for more something like a levered product where they could just deposit the collateral, or have this, just exchange the payoffs?
I think people, unfortunately, I have to say that it's still, when we get asked about our indexes, it's still about what is Bitcoin and what is Ethereum. So having already staking something is an advanced thing for a lot of institutional investors. So I think for such more complex derivative products, I think it's I don't see that necessarily next year, maybe 2-3 years out. But it's still we are so early. Sometimes we forget that when we are in that space. We are losing patience. But it's still, we have also so many beautiful baskets, but it's still just about Bitcoin price index, Ethereum price index, and then maybe we talk about staking. So I think that's more for the very sophisticated hedge fund investor, maybe. Yeah.
Yeah, I think so. So, it's really been a pleasure to talk to both of you. You both have very strong TradFi backgrounds, but also very crypto native. So this is quite a joy. For the last 12 years or so, I've been speaking with a lot of people. For a long time it was I like blockchain, but I don't like Bitcoin. To now crypto assets, and that was around the 2020 side to everything's dead, and now onto Bitcoin ETF. So always nice to have people that understand that there are all kinds of nuances, all kinds of different sets of assets, yields, earning opportunities, relative value, trading. It's quite nice, I gotta say.
Yeah, Darren, I think like the overarching here is we are finding a way to bring everyone in, and I think like the original ethos of crypto, which is definitely something I adhere to, is like we're talking about not your keys, not your coins, but like we were saying as we started the call, my dad's definitely not going to go not your keys, not your coins. He's going to go Fidelity brokerage account spot ETF. So we need to build products for everybody, and I think when people understand that crypto can't be shut down, that it's a new financial paradigm, that it's democratized finance, that it's available globally 24/7. They'll want exposure to it, and even though we're taking these types of crypto assets and wrapping them, putting them in traditional wrappers, the underlying ethos is still very strong with us, and I think MarketVector feels the same way, and so happy to be a part of this, and thanks again for including us, and looking forward to seeing your guys' rates develop over the course of the next few months.
Yeah. Thanks, Darren. Keep up the great work, and thank you very much for the opportunity to speak.
Yeah, thank you guys. Where can we find out more about Figment or MarketVector? We see Figment on the speaker list. Make sure to follow them on Twitter. Make sure to follow Martin. Make sure to follow Josh. And where can they find out more information about your services?
It's MarketVector indexes.com or MarketVector.com. Both works, and you can find me on LinkedIn, Twitter. Just Google us. So that's easy to find.
And Figment is, obviously we have our handle up here, so definitely give the handle a follow. We do a fair bit of research. We've got people much smarter than me at the organization. We wrote a piece about MEV opportunities the other day that I like is phenomenal. And Figment.io is our website. And give us a follow, and appreciate everyone listening.
All right, great guys. Well, we have an early Christmas gift which will be coming out soon. You guys, if you're stuck at home, with chats about Bitcoin ETF, are we dead? Are we back? Are we going to make it? GM. You can sit at home. You can trade some stake rate swaps right into the new year. So thanks for joining, and see you guys next time. Cheers.